Hello, happy Wednesday. Real quick touch base with regards to some of the stuff we're seeing in markets right now. Volatility is really starting to shoot up amidst price movement in the market too. And that's okay. As you know, one of the things that we do every single day is run through a gamut of mathematical probabilities within pretty much every asset class, every index, currencies, interest rates, you name it. We still believe that we're moving through phase 3 of the economic cycle, and phase 3 of this cycle basically is the realization that stagflation is becoming very real. So therefore, some of the assets that we would like to own have just not stopped going up, even amidst all the changing in volatility measurements and things of that nature. Some would say, well, why don't you just buy that? Well, the main reason is risk management. There are times and places where we want to expose ourselves to risk, and there are times and places where we want to mitigate and minimize risk. And right now, the asset allocations that are consistent with doing well within the lens of stagflation are focused primarily, as I've said a number of times, on treasuries, gold, commodities, technology, utilities, real estate, and emerging markets, primarily at this juncture, China, Indonesia, Russia, Finland, and Norway. And so there's two elements that I'm constantly looking at. One, where are we within the economic sine curve? Where are we on the lens of the current economic circumstance? And what's the technical signal? What's the mathematical signal telling me in terms of price volume volatility? And the one thing that I've come to have after a very, very long time is a very strong asset allocation and patience. And you need that in many instances because, as always, risk happens slowly and then all at once. Now, that's not to suggest that we're just going to see things collapse. I'm not suggesting that that's going to be the case. However, the last 2 to 4 days have had some significant changes in the structure of volatility of the market. And the one thing that's true in the calculus of markets is that particulars matter. And so what I mean by that primarily is the movement in the VIXN, which is specifically related to the volatility measurements of the NASDAQ, and VXAPL, which is Apple's volatility measurement. Why does that matter? Because Apple is in almost everything these days, and the extent to which it now takes up an allocation spot in the indexes and in almost every large cap mutual fund is tremendous. So any kind of break in Apple would be a fairly significant result or a significant situation in most of those things. Right now, the 5 companies of Facebook, Apple, Microsoft, Amazon, Netflix, and Google, they make up over 22% of the S&P 500 right now. Now that's massive concentration risk. So therefore, there are a number of things that we just want to pay attention to as it relates to price volume volatility, and we measure it every single day. So rather than stepping into too quickly or too heavily into the S&P or into the Dow or into the NASDAQ when they constantly are tapping the top end of their risk range, I would rather take a lower risk position in things like emerging markets, in treasuries, in gold, and for the most part in commodities. The last few days, you may have noticed a risk-off methodology within the portfolios, and that's just a function of what's been happening with volatility. But let me show you real quickly what I mean by sharing my screens with regards to volatility. So this is a picture of Apple's volatility measurement. And any price above 40 is a fairly high degree of volatility for Apple. Well, we've got 4 days straight where it has moved up above 40. So ordinarily what we'd be looking for is something that we'd refer to as episodic and non-trending. And then you look for episodic and clustering. And if it's now clustering with itself above 40 and no ability to get back down below 40, what that does is it just increases the chance of a price break in Apple. And when you look at Apple, primarily in terms of its lens of price, obviously it's gone up significantly over the last 6 months. Shoot, it's gone up significantly in just the last 6 days or 6 weeks, much less 6 months. And up until recently, Apple's volatility measurement had been fairly non-problematic, kind of a nothingness, almost like what we would call Brownian type motion. But then all of a sudden, volatility has a tendency to catch up to price in many instances, and what that does is it creates an environment for the price to break. Now you take that into consideration of where we are on the NASDAQ itself, obviously trending up towards the top end of its range. Mathematical risk range for the NASDAQ this morning was 11,513. It shot up considerably above that. But more importantly, its volatility measurement broke up above 30, and 30 was the new trend level or new trend structure for the NASDAQ. What's that mean? It just means that for a bull market to sustain itself with minimal to reduced risk, we'd want to see the VIX and VXN trend below 30. We'd want to see the VIX, VIX, which is general equity volatility, trend below 26, which it's still doing. It's at 23. And we'd want to see the major components of those indices, Apple being the largest, keep their volatility measurements in check as well. With Apple breaking above 40, staying above there for 4 days straight, and today, the first day we've seen NASDAQ break above trend in a reasonable period, while at the same time price has just been on a tear. All that measures up to the possibility and an increased probability of some type of a pullback, some type of a correction. That being said, if we get it and it breaks back down below or near the lower level of the mathematical probability that I put in my handy dandy notebook every single day, then technology would be a buyer, and we'd be buying things like the Qs, QQQ for some of our more aggressive accounts. We'd be moving in more aggressively towards QLD and the TQs, IGV, MGK, things of that nature. We would want exposure to a number of elements. I took down some positions in tech today that we owned, again, just because the volatility measurements were breaking out, price was breaking up above the mathematical range. A number of things were just happening that suggested I don't like the setup for general equities in this position comparative to other choices that I have. So on red, because it's on sale, you buy things like some of the commodity space. Rare earths were on sale, we added that. Utilities were on sale, we added that. Real estate was on sale, we added that. Treasuries were on sale. Extended duration treasuries and normal treasuries were on sale, we added that. In the morning, gold was on sale, added some of that. Some things just ran past us in terms of price, and so we didn't get a chance to add as much as we would have liked, but nevertheless, we add the stuff on sale, we prune it on green. Plant on red, prune on green. Repeat the process, right? That's basically what's going on. If you look at the volatility measurements of the emerging market space comparative to that of the NASDAQ and the VIX, it looks very, very different. So let me share that with you real quick before I end. So again, this is the VIXN or the NASDAQ volatility measurement. And as I said, trend is at 30. So the fact that it broke up above that fairly strongly today is not what I would want to see in the midst of its price moving up. What I would like to see even worse, though, is its volatility measurement moving up while its price breaks down. That would be a bad position. However, emerging market space, very much nothingness, very, very quiet, very, very low on the spectrum of what we would refer to as risk in terms of its trend. You can see that this trend is still moving down comparative to this trend that looks like it's starting to move up here. Volatility measurement for Chinese equities, again, still trending itself in a reasonably good position. Anything below 30 for the emerging market space or Chinese equity space is in a good spot. And so obviously these two equity volatility measurements are in very good positions. And so therefore on red, I would want to gross up my positions in some of the Chinese space. We did a little bit of that today in the Chinese A shares, symbol KBA. However, the Chinese internet space was overbought, and so therefore I pruned, took a little bit off the table, and minimized some of the exposure there. Treasuries were on sale, so therefore we bought some of those. We bought some extended duration Gold was on sale this morning, and then it started to move up. Why did it move up? Because the volatility measurement was breaking down in the morning, and then it reversed. That's okay. You know, anytime you see price come down while the volatility measurement is also breaking down is great. You absolutely love to see that when you're looking to add to core positions that we hold. So in a nutshell, that's some of the things that we're doing right now. Just again, trying to stay focused on risk management. The equity market in general, in terms of U.S. equity space, the S&P, the NASDAQ, things of that nature, have had an increasing degree of risk, and has certainly started to materialize that the last few days when viewed through the lens of volatility of the NASDAQ and specifically some of its largest holdings like Apple. So we'll continue to work the plan. The plan is staying focused within the realm of a stagflationary equity environment or a stagflationary economic environment, moving into phase 3. Remember, phase 1 is going from depression to recession. Phase 2 was a reopening bounce kind of a scenario. Phase 3 is the reporting of an economic reality, and some of that reality starting to point towards less confidence. Some of the confidence numbers came out recently, and they were not awesome. That can shift, and we recognize that that certainly could be the case. However, when stagflation has been in place, you take advantage of the movement of commodities. And so last thing, real quickly, we owned corn all the way in here, sold some corn here, sold some wheat up here, sold coffee actually yesterday here, sold soybeans up here, sold some cattle and hogs up in this range, and in the next day or so I'll probably start to buy some back. I was hoping to buy some this morning, but just couldn't get the price that I wanted, and sometimes the time goes past you quicker than you like, and you miss something on the buy side. But that's okay, they'll be back. Sugar cane is something that's a little bit tight. I would like to own it, but it's just very minimal in terms of its trend and trend strength, and certainly the volume movements. Palladium looks pretty good. Gold, obviously I showed you that looks good. I missed the opportunity to buy silver today. It just didn't stay down long enough before it started to shoot up. So yeah, some goods, you take some winners, you take some misses, and you move on. It's all about mitigating risk, minimizing some of the risk of any kind of downward movement or hurt in the portfolio that would be problematic. You know, we certainly don't want to see any kind of capital evisceration to the 20, 30, 40% range. That's just, in my opinion, not acceptable. So, anyway, that's where we're at. If you have any questions at all, by all means, please let me know. Email Chris at careformywealth.com, direct line 608-354-1977. And as always, I welcome your questions. Always looking forward to talking to you. Thank you again for the opportunity to work for you, and hope you have a blessed night. See you soon.